Raising capital refers to the getting fund for your firm from investor, venture capitalism, or other sources giving you enough fund to make your dream turn into reality. Raising capital is one of the most crucial aspects of any company. If you don't have the money to get started the business, having a fantastic concept and the necessary contact, it is pointless. Your firm will not be able to get the ground without funding. You will need it to buy items or materials, pay employees, maintain a steady cash flow, and manage your firm on a daily basis. Before you do a raising capital, you must plan the funding strategies such as how much you need, when you will need it, how long you will need to raise the money, from where you will raise it, and how you want to repay it back. You must think and plan all of this before do a raising capital. There is two ways to obtain a capital, such as debt capital and equity capital. For the debt capital, such as bank loan, personal loans, bond, and the credit card debit are the most popular form of debt capital. A corporation can raise cash by asking for a new loan or creating a line of credit when it wants to expand. Other than debt capital, it is a equity capital. It is rather of borrowing money. Equity capital is obtained via the sale of the business stock. A corporation can obtain cash by selling extra shares if taking on more debt is not financially feasible. This can either be common or preferred stock. Other sources for equity capital is private investor, institutional venture capital firms, mergers and acquisition, strategic investor and corporate venture capitalists, and overseas investor and the intermediaries. We move to the life cycle of business. A life cycle is a set of events that begins with the birth of a new product. There is a 5 stage in the life cycle of business. We move to the explanation for the every stage. For the first stage, which is launch, each firm begins as a business, generally with the debut of the new products or services. Sales are the models during the initial phase, but they gradually and ideally consistently increase. Business advertise their competitive advantage and the value proposition to their target customer groups in order to market to them. Business are prone to losses at this phase since income is low and the initial launch expenditures are considerable. And after that, the second stage is a growth, where businesses are seeing a strong sales growth. Businesses begin to earn as they reach the break-even threshold as sales climb significantly. However, because of the profit cycle is still behind the sales cycle, profit is lower than sales. Finally, during the expansion stage, the cash flow turns positive, indicating an extra cash inflow. This stage is shake-up, where sales are increasingly rapidly in businesses. As sales increase sufficiently, business begin to earn as they approach the break-even point. Profit, on the other hand, is lower than sales since the profit cycle is still behind the sales cycles. Finally, the cash flow turns positive during the growth phase, suggesting an additional cash influx. Other than that, the next stage is maturity, where the company becomes older. Revenues gradually decline, profit margins are shrinking, but cash flow remains stable. As businesses mature, substantial capital expenditure are generally behind them, resulting in a larger cash creation than the profit on the income statements. And lastly is the last stage is decline, where in this stage, sales or profit and cash flow all decrease at the end of the firm life cycle. Companies admit their failure to prolong their business life cycle by adjusting to new business environment. At this phase, companies eventually lose their competitive advantage and quit the market. We move to the importance of raising capital. First, it is important to have raising capital for the business or firm expansion over the course of a few years. There was an expansion and growth. Funding is essential to expand the company's capabilities in terms of the raw sources, infrastructure, facility growth, marketing, and the promotion, and so on. Moreover, the next important of raising capital is the asset purchase. Any company's assets are its cornerstone. It might be money, equipment, property, or a structure. The process of purchasing asset is made easier by raising funds. For speed up the work, raising capital is a vital since it speed up the job by allowing for working capital requirement in the day-to-day operation of the company. Other expenses include personnel pay, warehouse and storage facility maintenance, commodities manufacture and manufacturing, transportation, and so forth. Lastly, it is for the debt reconstructions. At some time, a company will confront the financial difficulties. In such circumstances, debt consolidation comes to the rescue. It is basically decrease and reconstructs debt and relieve an entrepreneur's excessive load. There are several ways to raise capital. It is critical to have a plan in place for this. A business can raise cash in a variety of methods. The next one, how business raise financial capital. Step or a prototype for a product or services to offer, but few clients, if any, and hence are not profitable. When it comes to acquiring financial resources, such businesses have a tough time. Firm or business may get their original sources of money from their own money. Maybe some of the owner for small business are dipping into own bank account or borrow money to start the business. Venture capital is a sort of private equity and a type of funding provided by investors to start-ups and small enterprises with the potential for long-term growth. Well-heeled investors, investment banks, and other financial institutions are the most common sources of the venture capital. It does not necessarily have to be in the form of money. It may be in the form of technical or management skills, small business with outstanding development potential, or business that have expanded swiftly and are set to expand are frequently given the venture capital. After that, it is by reinvesting earnings. If the company earns profit, they have the option of reinvesting part of this gain on equipment buildings, and research and development. One of the key sources of financial capital for many established business is reinvesting their own revenues. Companies and firms may have a wealth of appealing investment potential, but limited existing earnings to invest. Even major corporations can have a yield of too low earnings or even losses. But unless they can find a regular and a stable supply of financial capital to continue making genuine investment during these difficult times, they may not be able to survive until the better times arrive. Firms frequently require financial capital from sources other than earnings. However, the other way of business raise financial is by borrow from banks or bonds. Certain business or firms may make a loan from bank for a certain amount of money and promises to pay it back in the future, include the interest per month or per year with the period of time that agreed by both parties. If firms or the business are failed to repay back the loan and the payment, the bank may take the company to court and order it to sell all the assets to recover back the debt. The other way is bond. Bond is a financial contract which the borrower promises to return the amount borrowed as well as a rate of interest over a certain period of time. There is a few types of bond, which is corporate bond, treasury bonds, agency bond, and municipal bonds. Lastly, the way how to raise a capital is by selling shares. Firm or business can generate their funds for the operation or make a new investment by selling shares or issuing bonds. When a firm sells its own stock to the public to gain the fund or capital from the sale of its shares, the first sale of the stock of the firm to the public in initial public offering, such known as IPO. After issues in the IPO, it provides the fund to repay back the early stage investor and the venture capital, and the benefit of an initial public offering IPO is that it gives the existing companies with financial capacity to expand their operations.
Assalamualaikum, my name is Raja Aida Adriana. So for the sources of the raising capital, it is essential when closing sources for raising capital in business that it is adequate for the needs of the business. For example, making sure that it is enough to pay for what its company needs. The main sources are loan capital, venture capital, ordinary share capital, and personal funding. Loan capital is one of the most common ways of funding a business loan. It is often used to purchase fixed assets such as land and machinery. Typically, companies are repaid in monthly installment, and the bank will usually require collateral in the event of a business default. Although large amounts of fundings are available, loans are becoming increasingly difficult to get, and the application process can be long-winded. Venture capital is an extremely risky type of investment that a venture capitalist will make in a business which it is believed has a huge growth potential. Venture capitalists provide long-term committed share capital to help companies grow and succeed. Next is the venture capital. Venture capital is money that is provided by the investor to startups, and in exchange, the startup is going to give the investor a certain portion of their company. Venture capital helps beginner investors to grow and see that they are going to be a lot more in the future. So venture capital firms that can provide valuable expertise, strategy, direction, and business connection. In addition, initial capital investment company venture capital often invest in a particular industry that company are knowledgeable about or have previously worked in it. The venture capital industry has four main players, which are firstly entrepreneurs who need funding, investors who want high returns, investment bankers who need companies to sell, and the venture capitalists who make money for themselves by making a market for the other three. Venture capital firms also protect themselves from risk by co-investing with other firms. They also decrease the workload of the venture capital partners by getting other involved in assessing the risk during the due diligence period and in managing the deal. Firms need to make their own assessment of the industry fundamentals, the skill and funding needed, and the possibility of success of a reasonably short time frame. For the next part is the underwriting. Underwriting from the banker perspective, existing in the negotiation and structuring of a merger or acquisition with a deal, and this could be on the advisory side as an investment bank or a transaction advisor or in-house. In a corporate development and similarly on the capital raising side. The first is the planning part. Second is assessing timing and demand for the issue. And third is the issue structure. In the planning part, it is important to identify the teams, understand the rationale for the investment, get a preliminary view of investor demand or interest in this type of an offering. There are three types of underwriting commitments. First is a firm commitment. Second is a best effort, and third is all or none in firm commitment. The underwriter buys the entire issue and is responsible for anyone shares. A best effort basis is the most common, which is a market deal where the underwriter agrees to issue the security but does not make any promise about how that deal will be performing. Finally, all or none is the transaction. The entire issue must be sold or the whole deal is pulled. And then new equity share. Issuing new share of a common stock is more costly than financing with the existing share. It helps to make a better investment decision, and from a corporate finance perspective, the investment and decision is whether the firm should build a new factory or should buy some other company or introduce a new product to make the decision. New shares are usually underpriced. The firm sold below the market value, and commonly in initial public offering where a private firm goes public, companies like eBay and Netscape. The reason it underpriced is because it will make it easier for the investment banker to place the share to have them to sell to mutual funds and pension. It will be going to be flotation costs. Stock prices tend to decline when new equity is issued. The possible for this phenomenon is signaling and managerial information. Last but not least is the issuing cost. Corporation can issue stock directly to the investor or indirectly through an investment bank. Investment banks consider several factors when trying to set the initial stock price, including the future earnings, market condition, and anticipated dividend rates. After the initial offering, the market price of the stock is determined by the supply and demand. Proceeds, it is important that entities give attention as there is a specific accounting guidance for the type of cost that firm needs to follow properly account for their company. Some of these guidance can be complex depending on the type of funding that was raised. The firms need to track all costs that were incurred as part of the financing transaction. Second, identify or mark those costs that are incremental and direct to debt financing. These are the costs that otherwise will not be incurred if the issuance costs incurred for debt financing are capitalized and presented as a direct deduction from the recognized liability on the balance sheet.